We are here with a panel of investment gurus and titans. Want to get right to it after hearing what the Treasury Secretary just told us. I'm joined up here on stage Mohammed El-Arian, Chief Economic Advisor, Allianz, former Chairman, President Obama's Global Development Council, Thomas Fink, Chairman and CEO of Barings, Scott Miner, Chairman of Investments and Global Chief Investment Officer, Guggenheim Partners, Arunma Otek, Vice President and Treasurer of the World Bank, and David Solomon, President and Co-Chief Operating Officer at Goldman Sachs. And thank you all for being here. Appreciate it very much. What did we just learn from Stephen Mnuchin? What are your reactions to the tax plan on the table? Kick us off.
Sure. Well, I think the biggest thing I've learned listening to the Secretary and also in some of the discussions already around the conference is really the outreach and the information they're getting and making these decisions and the process. I think a big thing here is going to be the process. So we're at a starting point. I think there's a lot of work to be done to pull together, whether they do it through reconciliation or not. But there's a process underway, at least in starting, that we hope, I hope, that we'll get some done. I agree. At the end of the day, whether you buy into the growth projections or not, we need the tax reform.
Scott?
Well, I think I was pleased to hear the Secretary talk about bipartisan support because the tax plan that's been outlined is pretty broad. We need to find some sources of revenues and some places to cut some expenses if we're going to hit the revenue neutral point. So, but I think the Secretary's got a good first start at it.
Well, we know what the markets have thought, right? We're talking about a gain since Election Day, David Solomon, in the double digits. You look at a stock like Goldman Sachs or any of the banks that are up sharply. Is the market getting it right?
Is the market getting it right? Well, I don't know if the market's getting it right, but it's certainly right today. Look, I think that the animal spirits are out a little bit. We've got an improving global economic picture for sure. You look at earnings here in the U.S., earnings so far, which have been primarily weighted to financials, industrials, big tech, all look pretty good. There's more to come in the context of consumer, REITs, energy still to come. But there's a lot of policy that's generally reflative, good for asset prices, good for markets that's being discussed. And the question now is, will we be in a position to see some of this policy, implement? And what I'd say is that the market had enormous conviction about the direction of policy right after the election and through the end of the fourth quarter. And this quarter, it feels like that conviction is a little more muted because when you get into the process of actually legislating a bunch of these policy decisions, it's complicated. And so we'll see.
And we saw that just recently. We're still seeing it in terms of healthcare. Do you think we'll see tax reform in 2017?
I'm hopeful we'll see tax reform in 2017. I think that we need tax reform. I think the simple process of simplifying the corporate tax structure, getting a bunch of cash back on shore, simplifying the personal tax structure all makes sense. But I think it's hard to actually get it done. So, I think we'll get something done in the context of 2017. The question is what and where will the compromises be? At the end of the day, it's all about compromise.
Arunma, how does the World Bank see it? And do you think that a change in the economics in the U.S. will mean a big change for the global economic story?
Oh, absolutely. Where the U.S. goes is where the world goes, in my view. What I really liked is the emphasis that Secretary Mnuchin placed on the commitment of the administration to spurring economic growth. We need the U.S. to grow for the world to grow. One of the things that I liked very much is the comments that he made about supporting the financial services, because at the end of the day, finance is good for growth. It's good for the world. What I'm excited about, which President Trump has mentioned, is the emphasis on infrastructure. And if you take our experience over 70 years from around the world, if you increase infrastructure stock, it will certainly spur economic growth by up to 2%, depending on the stage of development of the country and depending on the nature of infrastructure. And, as I sit here today, 56 years ago, the World Bank financed the bullet train that connected Tokyo and Osaka. from 1963 to 1975, we provided loans to Singapore for telecom, for their ports, for power, and all of us are very excited about what Singapore has done over the years. 70 years ago, we gave our first loan to France. And I say this because it's always good to go back in history. And when people think about the World Bank, we often think about the developing and poor countries, but it's also good to look at the success stories, and some of what I experienced has been. And so I'm excited about the possibilities of infrastructure, and I hope that the administration will be supported in the way that I believe that President Eisenhower was supported for the 44,000-mile interstate highway that many of us still rely on today.
It's a nice reminder of how important growth really is,
Yes.
and how growth can move many ships across the world. Mohamed El-Arian, you have been encouraged by some of the plans you're hearing about, but you're not so sure about markets getting ahead of themselves right now.
So if you listen to what the Secretary said this morning, it is encouraging that the administration is emphasizing economic growth. And I love this notion, to use his word, that the tax plan is our jobs bill. That's a really good way of seeing it. It is encouraging that they realize that the tax plan is not enough. He mentioned deregulation, and he mentioned trade. So I think that is really encouraging. What I think we're all going to find out is that the tax reform component is a lot easier to implement than the tax cut component. That is going to be quite complicated politics on the tax cut. And the other thing we're going to find out is that you need a lot more to promote economic growth. You cannot wait for infrastructure. I agree with you, infrastructure is critical, so that should be sequenced up front. And you need to do more on the productivity side in order to enhance growth. So I think the emphasis is correct, but when it comes to the details and when it comes to the implementation, there's going to have to be a rebalancing of policies to validate what the market has already priced in. David is absolutely right. The market has priced in a lot of announcements, and now we need the actions.
Well, I tend to agree with Mohamed that the market has priced in a lot of optimism right now. And while I think that what we're hearing out of Washington gives us reason to be optimistic still, there is a moment where we're going to have some delivery. And so, I'm a little bit concerned that if we don't see some movement on tax reform before the end of the year, or we don't see some movement forward on health care, that the market is going to start to doubt the administration's ability to actually deliver. And so I think that's the big challenge ahead of us, Maria, is that can we start to deliver on some of the promises, and which promises can we deliver on? So
far, it feels like there's a bid under this market until something goes horribly wrong.
Right, and there are a lot of things out there that could go wrong. Some sort of military confrontation with Korea that doesn't go very well, or North Korea, that is, or just a failure on the part of Congress to actually start to be able to implement some of the changes the administration is looking to make. I think that everybody will agree the president's program is a pro-growth agenda. It's do we have the willpower politically in Washington to get it done?
And I think there's a lot of pieces that go even beyond getting this legislation done. A lot of this has to do with the trade policy that you talked a little bit about, and how we are dealing with China and other countries in terms of direct investment. So if you think about all the questions, there's all these big issues on his priority list, which are all very relevant, but any one of them is very hard to achieve in a short period of time, and the market might just grow tired of waiting.
The idea of 3% and 4% in terms of economic growth, how realistic is that at this point? Let's talk about some of these policies and what the impact would be in terms of dictating behavior. For example, David Solomon, with a much lower tax rate, 15% for small business and big business, by the way, would that dictate different behavior on the part of a CEO in your view? Will that person say, okay, I'm keeping more of my income, I'll create more jobs?
Look, there's no question that you can look at the way companies operate around the world, and in jurisdictions where there's a very, very competitive tax structure, you tend to create or attract investment. And so I think it's pretty clear if we had a more competitive tax structure, corporate tax structure here in the United States, that should spur investment and it should create benefits for the economy here. All of it comes ultimately through not just the concept, but when you really get down to the details of exactly what we've done and what else is going on. The thing that I find so interesting when you're talking about the markets here and what's going on from a market perspective, there's no question that the comments that have been made, the market's pricing in some excitement about our moving in a different policy direction. In other words, if you go back to November, the world thought we were over here, okay, and the world thought the next thing we were going to get was also over here. And we got something that moved us, in a different direction. People are excited about that because that can move the market in a positive direction. But there's a lot going on in the world. The world's a fragile place. Massive disruption coming with technology. There's going to be lots of competition. There's opportunity for growth, but there are also a bunch of deflationary pressures, in the economy that are going to continue to push. And I think the matrix or the cocktail of how that all gets mixed together is very, very complicated. But at a high level, a more simplified corporate tax structure should spur investment here in the United States, and it should be good for economic growth.
Well, I would concur when you look at the World Economic Forum's review of the United States, the tax issues are what businesses think are the most problematic factors. And so addressing them is extremely important. But I do want to say that optimism is extremely important. And I think I've appreciated the rally in the markets, the optimism that we've seen. And I appreciate the fact that the Secretary Mnuchin is focusing on regulation in the right way. Enough regulation, because maybe we swung a bit too far to the other side. And for you to have capital markets that have the depth that the United States capital markets have, you do need regulation that is just right. And I say that because, if you think about America, for me, is a leader in innovation. And one of the reasons it's led innovation, it's the quality of the capital markets, because it's a meritocracy. Capital allocation is given to those who can best use those resources. The World Bank is able to do what it does around the world because of the depth of the capital markets of this country. I mean, it's been more than 70 years since the World Bank was set up, with $15 billion of paid-in capital. We've been able to leverage ourselves 40 times, and we've been able to basically raise funds that are reasonably priced and to do development around the world because of the depth of these capital markets. And optimism, regulation are extremely important. And innovation, of course.
It's a very important point that you're making. There are no other markets that are as deep and have the breadth that the U.S. markets do, which is a really important point. You were going to jump in.
Well, I was going to jump into the point about the lower tax rates. Certainly lower tax rates in the United States should achieve one of the administration's objectives, which is to bring back manufacturing to the United States. The tax rates in our country have been too high. I think we know this now. And so I think the lower corporate tax rate should be good to bring employment and, in the near term, help spur growth.
So, Maria, I don't think there's any question as to whether there is optimism and whether the optimism is warranted. I think a lot of things that trouble people in this room is the contradictions that they have to deal with. So yes, the stock market is doing great, but what are 10-year bonds doing at 2.30? They were 2.60 a few weeks ago.
Well, we just had a GDP that was really weak.
But even before that.
Okay.
Yes, the soft data is wonderful, but the hard data, GDP, retail sales, inflation, suggests a soft patch. Yes, the optimism is off the roof, is off the charts according to the stock market, but the geopolitics are a real concern. So I think part of the puzzle is how can we have all these contradictions together, and how does optimism prevail over these other signals? And I think we've learned two things. One is we have a lot more time for resolution than before because there's so much liquidity in the system. And we have been conditioned as a marketplace to buy every dip. So there is a lot of time to reconcile these contradictions, which is a good thing. And the second thing is, in order to reconcile them in a positive way, you need policy actions. That announcements will not carry you forever. But I think part of the hard thing, if you're in this room, is do you pay attention to all these other signals that are not as optimistic?
Yeah. Well, I would add to that, I think there's an underlying current here. We talk a lot about the impact of the government and deregulation, tax reform. Yeah, the economy is fundamentally changing. You look at industries like retail, where the Amazon effect is coming through. Well, for every winner in the technology side, there are losers, and we're going to see that play out in local economies, local real estate, and so there's a counter effect to some of this growth of the new economy. It's at the expense of other businesses and industry, which also affect growth over time.
So it's not as strong as the first headline number or headline comment shows.
There's a lot of volatility between the two.
Yeah. Let me ask you about deregulation while I have you here, Tom, because your industry is obviously going to be really impacted by the rolling back of regulations. Have you felt that alleviation yet? Anticipation of change?
I wouldn't say. We're insurance owned and we're an asset management firm, so we deal with a level of regulation, whether registered investment advisor, and we really haven't seen anything affect it in the short term. There are things like risk retention and maybe changes to the DOL rule, which could impact managers going forward. Clearly, you're probably less worried about more SIFIs and more looking at, how does regulation, start? How do you start up mortgage market again from a private perspective with the GSE reform? So I don't think that anything's really changed from November to today. It's more what's going to happen. Will we simplify things? And how does it maybe make it a little more economic to run your business?
Same question for you, David Solomon, on regulation. The rollback of the rules. What's the impact?
Well, I'd agree with what was said. There's not been a rollback of the rules at this point in time. I guess the way I'd look at this, and the secretary made comments along these lines. We had a horrible financial crisis. There was a massive amount of regulation that came into play. The fundamental purpose of that regulation was to make the system safe and sound. Certainly, some of that regulation had a meaningful impact on bringing down leverage and recapitalizing the system. But there were a whole bunch of rules that were put in place, and nobody ever really looked at the amalgamation of what was put together and said, okay, how does this all work? What's the interplay? What is the cost-benefit analysis in terms of making sure we're spurring investment growth and allowing large financial institutions to do the things that they have to do that help support economic growth in society? And so after 8 years, it's not a bad thing to step back and take a look at all this and say, how does it all relate? What's working? What can we do that makes the system more efficient? What can spur or be growth supportive as opposed to things that are creating headwinds to growth, while never at any point in time changing that fundamental foundation of safety and soundness in the system. And this is a good time to take a look at that. I do think, and the Secretary said this in his comments, that there are a handful of things that you can do that will improve or help the system move forward, and comments around transparency. What are the rules? How do they work so that people can plan and plan appropriately? I think that stuff all makes sense. There are lots of reporting requirements that are very, very burdensome, but really don't affect safety and soundness, particularly around the VOCA rule, for example, and how can that be amended in some way, shape, or form that can create more market liquidity, because market liquidity is very important. So all of that is out there for discussion. I think it's great that the Secretary and the administration are talking about these issues, and we'll see what the effects will be.
Yeah, right now it's a little bit of guesswork in terms of how these rules or rollback and regulations will impact things, but sort of practically speaking, if we have lower rules, or fewer rules rather, do you think that creates more deals? Would that trigger consolidation? Would that trigger, a change in the business climate? What would be the actual result of this, in your view?
So, more deals, more activity. Look, everything ties to growth, in some ways. And we were talking before about confidence. One of the things that I'll note right now, just because we're talking about markets and confidence, is CEO confidence is as high as it's been since 2004. And that affects deals, and that affects market activity. I don't think that the regulatory change should be linked directly to changes in when you're talking about banks to specific changes in overall economic activity. But what we do need our financial institutions to do, we need them to lend, we need them to provide liquidity, we need them to make markets, we need them to participate, in the marketplace, and rules that in some way inhibit or hold them back, rules that might create some benefit, but when you look at the cost-based analysis of what kind of risk you're protecting versus what kind of benefit you get, those are things that we can look at. And by and large, I think the way the regulatory push moved and the speed with which it moved, it created some headwinds to growth. And so to the degree that some of that gets adjusted, I think there's opportunity for improved growth and therefore improved activity.
I think the Treasury Secretary has the right tone. And David reinforced it, which is that you do need people to understand the rules. You need more transparency. But my experience as a former regulator is that people are generally opportunistic. And so if you take what's happened with Basel III, where the banks have not been able to do as much because of capital requirements, what you've seen is a number of institutional investors start to look at asset classes that they traditionally wouldn't have looked at because the banks haven't had to be able to lend, for example, into infrastructure. And for insurance companies, for pension funds, where their liabilities are longer term in nature, it has inspired them to start to think about how they can do things differently. And in a sense, how to partner with the World Bank, how to focus on EM infrastructure. And I say this because, of course, we manage our own funds, and we manage funds for central banks and pension funds around the world. So I think that if the rules are clear, if they're transparent, then people are opportunistic and focus on how they can, in a sense, take advantage of the rules.
Yeah.
Yes.
I think the other thing we're learning is that if you get higher economic growth, more things are possible. So you can prudently deregulate. You don't have to worry about deregulating ahead of another crisis. Another thing I think we're going to learn is that if we get growth, then the Fed can do something that many of us were wondering about, which is, can it normalize policies without causing an accident? Ray Dalio had this concept of a beautiful deleveraging a few years ago. Now there's a possibility of a beautiful normalization of monetary policy if we get growth. And we're going to have to learn to get used to a Fed that leads markets again as opposed to follow. But if we get growth, a lot of other things get solved as well.
But do you worry that the Federal Reserve is on now a new path toward raising interest rates just at the time that we're just beginning to see the economy get some traction, and we haven't actually seen it yet because we just had this GDP report of 0.7%, which was underwhelming. Is now the time to ramp it up in terms of raising rates?
Yes. First of all, the GDP number, and I'm not normally optimistic, but the GDP number of 0.7% had one-off effects that are reversible. 2, there's a seasonality element to it. And 3, it hid the fact that exports and business investments are doing well. So this was not as bad a GDP report as the number suggests. Second, we need the Fed to normalize. The collateral damage and the unintended consequences of running unconventional policies for too long can become a problem in itself. So there is a window for the Fed to normalize. Now, we're not talking about the Fed taking interest rates to 5%. We're not talking about the Fed selling securities back into the marketplace. We're talking about a very gradual process that will see probably 2 more hikes this year for a total of 3.
Right. I think the Fed is on the right course right now. Obviously, they always have the caveat that everything's data dependent, so they could change direction at any moment. And I think I agree with Mohammed that we'll get 2 more increases this year. The big question in my mind is how will they manage the balance sheet going forward? And I think Dr. Yellen is anxious not to leave the Federal Reserve and not have a plan to get this done. And so by September, I would expect we'll hear a plan from the Fed.
To wind down the balance sheet.
Exactly.
Talking about $4 trillion?
Well, they started with about $1 trillion, so they only had to get rid of $3 trillion. Okay, so, so
$3 trillion.
Yes. So, but I think that Janet Yellen will be very concerned that if she were to leave the Fed and not address the balance sheet issue, that it would leave this Fed open to being criticized. And so I think the Federal Reserve is anxious to address the balance sheet. Whether that's the right decision or not, we'll find out. But I think they'll want to get started sooner than later, because if they get started later in the year, they have fewer options to adjust course. So I think by September, Maria, we'll hear what the plan for the balance sheet is.
And of course, the low interest rate environment, Arunma, has been one of the issues for a lot of emerging market countries.
It's been a very fascinating, uncertain, unprecedented period. On the asset side, you have negative yielding assets or very low yielding assets, and people say the numbers are 40 to 50 trillion dollars, and so we're hoping that will encourage a lot of asset managers to focus on emerging markets and particularly EM infrastructure, given the possibilities. And we're very, given our wealth of experience around the world, we're very ready to partner with investors. People have described us as being able to de-risk countries because of our influence over countries, because of course we're owned by 189 member countries, and if you're not in good standing with the World Bank, you're obviously not able to borrow from anyone. So we're hoping that given that it will take some time for us to get to normalization, that there will still be interest in EM. Some of the concerns are, of course, that a number of countries, there is an accumulation of private debt in EM. And so it's a headwind to worry about. But I think our experience is that EM has generally, based on their past experience, been able to weather some of the storm, and it's probably an opportunity for those who want to consider it as an opportunity for diversification.
I want to come back to this point because I know a couple of you on the panel are looking at emerging markets quite favorably right now. So we'll come back to that. I want to get your take on what the Secretary said about the dollar, because it seems to me that the U.S. has a balance to walk here. It's no new surprise, but as the administration comes out with these positive policies, these growth policies, and as hopefully we see growth move, people will buy the stock market, people will buy the dollar. Increasing the value of the dollar is only making things that much harder, making our products more expensive abroad. Your takeaway on the dollar conversation?
So the good news is that the dollar is a relative price. It's relative to another currency. Why is that good news? Because if it were an absolute price, what would happen is exactly what you said, which is that people would be attracted to the US by at least two things. One is higher growth, two is higher interest rates. The dollar would go up quite sharply, and that in itself would create economic headwinds and, importantly, would create political headwinds. So the US cannot right now afford a significantly stronger dollar. How do you avoid that? By having other countries also step up to the plate on what they need to do. And you need Europe in particular to step out of the plate. So an important element of the Secretary's job and others is going to be to try and convince, influence, inform, whatever word you want to use, Europe to also do what it has to do to promote economic growth. If that happens, then both areas grow together. The dollar doesn't become a major problem. If Europe lags, then the dollar in itself can become a major headwind.
I'd agree, and I think it's, again, we start talking about the U.S. a lot. Brexit's still alive over there, French elections, the German elections coming up. There's still this big question about the sustainability of the euro. And if that goes the wrong way, it only complicates matters worse. So the reality is we now live in a world where it's a global economy, there are global flows, and the impact of dollar, euro, dollar, sterling, dollar, yen, euro, yen those matter, and it's sort of a multi-level issue to manage.
Yeah.
But being one of the people here old enough to remember the Reagan administration, right? Going into the Plaza Accord in 1984, the dollar was skyrocketing, and actually got to parity against the pound, and the stock market was roaring. And yet, in the period after that, when the dollar weakened significantly, the stock market continued to increase. Global U.S. growth continued to grow. And so, I actually believe that Treasury shouldn't be focusing so much on the value of the dollar. If they get the economy right, the currencies will sort themselves out. And so I think the administration's interest in seeing a weak dollar to help exports might be a bit misguided. I think we would be better off let's get the fundamentals right about the U.S. economy and let the currency land wherever the right place is.
So, Scott, I have to ask you a question because the French election was raised, the German election was raised, Brexit. What do you do with the political side of the dollar? So, on the economics, you may be able to convince me.
Right.
But what about the politics of it?
Well, I think the politics of the dollar are short-lived, meaning that the dollar is a safe haven in times of uncertainty, and certainly the uncertainty that hangs over our heads right now with Europe is not to be ignored. But I think as Europe sorts itself out, the dollar finds its own level. So I think the strength that we might see in the dollar as a safe haven in the short run is a fairly short-lived
And the protectionism, the concern that the stronger the dollar, the more the threat of protectionism?
Well, I think protectionism and using the dollar as a tool for protectionism is a dangerous path. And I think, if we were certainly to look at a border adjustment tax and the impact on the dollar, I think that the consequences of those policies might be not quite exactly what would be best for long-term growth in America.
I mean, you look at just an automaker, for example, where in a car, certain components in a car have to cross the border 6, 7, 8 times. If they're going to Mexico to be installed in a seat and then coming back to the U.S., a border adjustment tax would be very difficult.
Well, and one of the things I think...
Not difficult, but just complicated.
It's very complicated. And one of the things people seem not to focus on is the bilateral nature of trade. I mean, certainly the administration's done a great job of taking advantage of that. But for instance, if you look at China, in February, there was a huge surge in Chinese imports of U.S. oil to China, as opposed to in January, where there was a deficit. And so the point is, if you're going to import goods from a certain country, it's very easy to redirect those imports to another country. And so you can actually manipulate the bilateral trade. And so if you want to put a tariff on the Mexican border, for instance, to bring in auto parts, then you're going to have a foreign importer say, well, I'll just buy the cars from Mexico. I won't buy them from the United States. And as you say, Maria, keeping track of all this gets extremely complicated and may have unintended consequences.
Well, there's been a 30-year process of building supply chains all over the world that were based on a bunch of assumptions. And when you start talking about the border tax, you're taking away the foundation of those assumptions. And these supply chains can't be rebuilt in 10 minutes. It takes years, decades, to build out those supply chains. And so the complexity of it is when you really look at manufacturing processes for so many things that we really take for granted, if you did have a border adjustment tax in some way, you'd have to really rebuild a lot of these supply chains, and that would take a long time. And there'd be a lot of costs that would wind up getting passed on, in the context of that.
Well, and I think you could, in the short run, lead to a lot of distortions in trade.
Yes.
That could adversely affect our position in the world.
Which is why it's not in there, and the president has pushed back on it. I do think, based on what Secretary Mnuchin just told us, there will be some revenue raise in economic policy. It will likely be in the trade economic policy. Let's go around the world and talk about where the growth is, what you're seeing in places like Europe and Asia. Thomas, to kick it off with you, with $280 billion in assets under management. How do you allocate capital, and what are you seeing in terms of flows right now?
Well, the flows we're seeing, we have about a third of our assets between our client assets in Europe, Asia, and the U.S. Clearly, the last few years, we've seen more into risk assets, more flows from Europe and Asia on the margin in our institutional client base. The reality is people are looking for yield. The common denominator is in the institutional, our clients were primarily large institutions, and to continue to look for yield. I think that's, we were talking earlier about infrastructure and infrastructure debt, and these are areas where institutions are moving in part because they need the yield, they need the income, relative to the rates in their countries, ultimately. So I think there's opportunity to deploy that capital. What we need to see in some respects is a little more pickup in business investment. For instance, in the U.S., to really not just keep refinancing debt markets, but to deploy credit into new business ideas and into growth. So definitely a lot of money around the world. Certainly growth in areas like Southeast Asia. We just need to see more growth here.
And Europe, you're seeing what? Are people warming up to Europe at this point or not?
They haven't abandoned it.
From an investment standpoint.
From an investment standpoint, it's very situational. I think the debt markets there, are pretty well bid. We look at the high yield market, and it's not as strong of a return maybe as the U.S. high yield market, but there's still yield there relative to where high grade corporate rates are, or sovereign rates. I don't think the negative issues you would look for in a credit cycle are as apparent in Europe or U.S. yet in the cycle. So we see some value in the credit markets.
Scott, similar portfolio, $270 billion in AUM. How are you allocating capital?
Well, we're very focused in fixed income. We're seeing a lot of flows coming out of Asia, particularly Japan. Coming out into the United States. And for a lot of the same reasons that Tom's talking about, which is, the yield pickup to come here. Financial repression is alive and well in Japan as it is in Europe. And, high yield assets are very attractive. One of the things, Maria, we've been doing is trying to lean against it a little bit with our clients, to get them to understand that we're late in a financial economic expansion. Credit spreads are extremely tight, especially in high-grade corporate debt and high yield. And so, this is a good time for people to upgrade their portfolios. And we have about 50% of our client money comes out of insurance companies. And as they're caught in the dilemma of trying to increase their portfolio yields to deal with legacy liabilities, and yet at the same time maintain a high asset quality, it's a real challenge, but that's the sort of thing that we're trying to navigate.
They're finding the most yield in corporate bonds, you said?
Well, high yield bonds are, still the cheapest thing out there. But, when you're sitting here, and Tom, you can correct me, double B corporate bonds are yielding, 4.5%. That's a high yield bond.
Stock market's up 15% since election day.
Exactly, and you could have earned 2% on your high yield bond. So I think the challenge for people is to not get forced into taking on a lot of credit risk when spreads and yields are so low, and to try to maintain a high quality portfolio. And so what we find is a lot of that trade-off comes in moving toward asset-backed securities and other places where you can get incremental yield without taking on the kind of risk that you have to in high yield and below investment grade.
You're seeing the same.
Yeah, you're definitely longer in the cycle, so you got to be more selective. We always look at it as our approval decline rate. And in 2009, it was 80%. Now it goes below 50. But then you also look at other asset classes, such as real assets, where you may see some incremental income and yield in a less correlated way to the credit cycle.
Mohammed, what about you?
So
Where do you see opportunity?
You've got to be more selective. I fear you've got to be a little bit more tactical than you'd like to be. And I think the third element is you need to reconcile valuations that are generally on the rich side with lagging sectors. And I think emerging markets is a perfect example of that. If you have certain risk dollars to put to work, I would put fewer of them to work, but I would allocate them more to certain markets that have continued to lag, even though they've done much better in the last few weeks. Emerging markets, for example, Europe, are lagging relative to the US.
That's a great point. Aruna, you're looking around the world and seeing very different situations. China just reporting a GDP of 6.9%, I believe. Was that the number? Where do you see growth right now?
I think that growth is in EM, but I'm obviously biased. We manage a very large dollar book, and as we think about what we should do, with all the uncertainties around the world, I have to confess that we're generally neutral to benchmark. And where we can be opportunistic, we will be opportunistic. So notwithstanding the opportunities that you can see around the world, I think we've generally been more comfortable at this time being neutral to benchmark because we've had a lot of surprises. I mean, we've had so many surprises since Brexit in June. And safe haven assets always do better when there are surprises. So our posture has been more defensive than it should be on the asset management side.
Yeah, and by the way, I'm not asking you allocating capital necessarily, obviously, but just in your role, you see all of the growth stories around the world and what you see as most attractive. But you did say that. David Solomon, walk us around the world. What are you seeing?
You know, the message that I would highlight is if we went back 12 to 24 months and we kind of thought about where we were and what growth looked like in the world, it looks better now. And so 24 months ago, people felt like the world was growing, 3.5%, and the world's definitely growing better. And if you take a tour around the world, there's definitely more growth, a little bit more stability around that growth, it feels like, at the moment. I was in Asia in the last 6 weeks. If you think about if we were sitting here last year on this stage talking about China and just what the sentiment was, in the first quarter around China, and you think about where we are now, I think the Chinese are very inspired or are very focused on managing the stability with the Party Congress coming up in the fall. But I think they've done a pretty good job. And when I talk to big multinational CEOs that are selling, into China, they say they see a real improvement, in the last 6 to 9 months with respect to consumer demand, coming out of China. And so that feels, relatively stable at the moment. That doesn't mean that it can't get sidetracked and we can worry about the amount of leverage and debt that's in the system there, but that feels pretty good. I was in Europe 2 weeks ago, meeting both with investors and also with CEOs, and there the general sentiment is a surprise that while not as robust as it feels in the US, growth's better than people expected. And if you think about when's the last time in Europe you've had all these elections, significant elections at the same period of time, those are things that create uncertainty, yet despite that uncertainty, the underlying economic growth, when you talk to CEOs across the continent, is actually, the growth's better than what they expected. I wouldn't call it robust, but certainly better. So you bring that back around, and into the US, despite the first quarter GDP print, labor's tighter, wages are starting to go up. We really are operating at close to full employment. There are lots of issues, but that package is generally growth's better. That, I think, is tempered by the fact that the world feels a little bit more fragile geopolitically. I think the nationalism and the protectionism, aren't good when you balance that, and I think there are more of those other risks that have the potential, to slow stuff down or knock us off or create disruption. But at the moment, and the way I kind of look at it big picture, is it feels like, by and large, versus 12, 24 months ago, we're doing a little bit better, and the market seems to be endorsing that.
You can't talk about growth without talking about technology embedded in every industry.
Everything.
Walk us through what you're expecting this year or 2018 in terms of the big trends, deal flow, innovation, growth.
Well, the big trend that every business is wrestling with is technology is changing the way every business is operating. It's disrupting everybody's business. Anyone that feels that their business isn't being impacted or disrupted by technology, is probably going to miss out pretty quickly. And so when you think about it, no matter what you do, you're delivering a product or a service to a client or a customer in some way, shape, or form. How you deliver that more effectively, more efficiently, how you improve the quality of it, how you connect with your clients or your customers to distribute. Technology and having the best technology to do that is what's differentiating businesses. And so the trend, around this is a significant trend. It affects labor, it affects supply chain, it affects margins in business. This is quite, it's going to be quite disruptive. And so I think we're going to continue to see, change around the impact that technology has on business. And it's not as simple as Amazon comes. Amazon's obviously, it's enormous. Amazon grew 27% on $130 billion of sales. But as Amazon's starting to build stores, malls aren't going away. It's a complicated matrix, but technology is really challenging businesses, and businesses have to think more aggressively about that.
I'm excited about the possibilities and absolutely what blockchain will do to the financial services sector, but we're very anxious about what it means for the poorer countries in the world, whether they'll have the same kinds of strategies that China had with AI and some of the challenges that represents. So I'm on the one hand very excited, but then worried about some of the consequences of technology.
And I think the way to reconcile this is to think of technology as enabling you to do things that you couldn't do before, as long as you're willing to disrupt the way you think about the business that you've run. So the disruption should be to the mindset, and that's what's really hard, because you have to think differently. But technology for every business enables you to do things that you couldn't do before, and that's what's so exciting.
Yeah.
And for developing countries, you can leapfrog so many levels of innovation right now.
No, you're right. I mean, the mobile telephone sector is a great example as to what happened in the last 20 years, and it was really the developing countries leapfrogging that led to some of the developments.
In developing countries, you don't have the burden of all the infrastructure.
Absolutely.
And capital, and so there's lots of opportunity as a result.
Well, I've been waiting for artificial intelligence to take over my job, and and some people say I have artificial intelligence now, but I do think that coming back to the Trump administration, one of the challenges I think the administration will ultimately face is starting to address this issue, which is going to revolutionize our society in the next 10 to 20 years. Robotics, artificial intelligence, all the things that can, as Mohammed says, we can embrace and can actually improve our standards of living. Or if we get it wrong, it'll take low wage jobs away. And so, finding the right policy mix for this is going to be a real challenge, but an opportunity for Washington.
And it is already taking low paid jobs, right? Robotics.
Well, you go to the pizza restaurant and
you're even seeing robotic prostate cancer surgery. It's pretty extraordinary what's going on.
But a lot of it too, and I think the other piece that's very important in this evolution is education. One of the things we got to focus on, not just the regulations and policies, but how are we thinking about the primary to secondary education path for the new jobs of the future? And I think that should be talked about a little bit more. It's one issue for today, but in 5 and 10 years, do we have the right education system for the future jobs?
What industries do you believe will be most impacted by the president's policies? Industries. Whether it be positive or negative, is there an industry that sticks out in your mind that's really going to see the big impact here?
Well, I think financial services are already getting hit or getting an advantage. I believe banks and especially the large banks will do well with this. As I mentioned earlier, I think manufacturing will do well with this. So I'll start out by throwing those two as winners.
All right, we will leave it there. Thank you, everybody. Thanks so much, ladies and gentlemen.